The crisis did not begin with a blackout or a geopolitical announcement. It began quietly, on a cold January morning in the year 2024, when several large solar manufacturers in Asia reported something they had never witnessed before. Their procurement teams were unable to secure the silver they needed for the next production cycle, not because the price was too high, not because their contracts were delayed, but because the metal was simply not available. Warehouses that had been full for decades were now half empty. The registered inventories in major exchanges had fallen by more than 60% since the year 2020. London vaults had been drawn down to the lowest level in 6 years. For an industry that depends on a thin layer of conductive metal for every single solar cell, this was the first tremor. It signaled something larger, something systemic, something no one had planned for. At first glance, this looked like an isolated supply chain hiccup. But in reality, it was the opening moment of a pattern that had appeared repeatedly throughout history. Every major monetary or industrial crisis begins the same way. Early shortages, rising industrial demand, inventories slipping, a belief that substitution or innovation will save the day. And finally, a breakpoint where the system must reprice an essential material in order to survive. This is how gold debasement hollowed out the Roman denarius. It is how Spain drained its own wealth while flooding Europe with silver from the New World. It is how the United Kingdom discovered the limits of empire when its sterling holdings evaporated after the Second World War. It is how the Hunt brothers ignited a silver panic in 1980. And it is how President Nixon closed the gold window in 1971 when the old monetary order could no longer sustain itself. The pattern is always the same: a long period of underpricing, a sudden surge in real-world demand, a refusal to adjust, then a shock. The world today is walking into the same structure again, but with a twist. This time, the crisis is not merely financial. It sits at the heart of the global energy transition. Silver is not an optional input for solar panels. It is the conductive metal that makes the photovoltaic cell work. No silver means no current flows. No current means no electricity. Every modern solar panel contains silver paste. Mono cells use around 15 to 30 milligrams. Multi-cells use 60 to 130 milligrams. There is no commercially successful substitute. Copper oxidizes and fails. Aluminum conducts poorly and degrades. Experimental materials work in labs but not in factories. Solar equals silver. Remove one, and the other collapses. This is stage one, the stage in which the world unknowingly ties its future to a metal it barely understands. While stage one passes quietly in the background, stage two develops in the open. It begins when demand starts rising exponentially while supply refuses to move. This is precisely what happened with silver over the past decade. In 2010, solar consumed 50 to 60 million ounces. By the year 2020, it consumed around 85 to 100 million ounces. By 2023, the figure reached 130 to 160 million ounces. And the projections for 2026 point toward 200 to 220 million ounces. Some analysts expect the figure to exceed 300 million ounces by the year 2030. Solar is now the largest consumer of silver on Earth, but supply has not responded. Global silver mine production has been flat for more than 10 years. The peak was roughly 900 million ounces in 2016. Today, the world produces only around 820 to 830 million ounces. There are no large new mines, no breakthroughs, no unused deposits waiting to be unlocked. 70% of silver is produced as a byproduct of mining zinc, lead, and copper. This means even if the price of silver doubles or triples, production does not rise. The byproduct model locks supply in place. One curve goes up, the other curve lies flat. The intersection between them is crisis. This is stage two, that moment when the system becomes mathematically unstable. For a while, technology and efficiency hide the imbalance, but the deficit grows. In 2021, the shortage was around 50 million ounces. In 2022, it exploded to around 180 million ounces. In 2023, around 142 million ounces. In 2024, again, around 140 to 150 million ounces. 4 consecutive years of deficit. No commodity market can sustain this forever. Inventories must cover the gap, but inventories are finite. And this is where stage 3 begins, the stage we are in today, the stage that always appears right before the system snaps. In stage 3, inventories fall faster than anyone expects. Industrial users begin to compete. Factories pay premiums. Long-term contracts replace spot buying. The cost of delay becomes higher than the cost of silver itself. Data centers, electric vehicles, medical electronics, and solar producers all draw from the same shrinking pool. The quiet market of silver suddenly turns tense. You can feel the tightening spread through the entire supply chain. Buyers begin to panic not because prices are too high, but because availability is uncertain. The crisis will not come from investors trading paper contracts. It will come from factories that need physical metal now, regardless of price. Industrial demand is inelastic. A solar manufacturer cannot simply wait for next month. A data center cannot choose a cheaper substitute. A medical device producer cannot redesign its equipment in 12 weeks. This setup is not new. History is full of warnings. In the palladium crisis between 2016 and 2020, rising industrial demand collided with stagnant supply. Prices rose more than 6 times. Carmakers were forced to redesign catalytic systems. The shock came not from speculation but from real-world necessity. The 1973 oil crisis followed a similar pattern. Supply became constrained. Entire economies faltered. Energy is the backbone of civilization. When an essential input runs short, everything shakes. In the rare earth crisis of 2010, a single policy decision in China disrupted the global electronics sector. Prices multiplied. Companies scrambled to secure supply. National strategies shifted within months. Silver is now approaching the same point, but the consequences may be larger because silver is the metal that powers solar energy, and solar energy is becoming the foundation of the new electric economy. The world has committed trillions of dollars to clean energy. The European Union, under its Fit for 55 program, requires massive solar expansion. The United States, under the Inflation Reduction Act, has issued the largest solar incentives in its history. China is expanding installations faster than the United States and Europe combined. Every one of these installations requires silver, not cheaper materials, not theoretical substitutes, real atoms of silver. The world is moving into stage 3 with alarming speed. The signs are already clear. Solar manufacturers are securing multi-year contracts. Refiners are reporting rising premiums. Banks are warning of industrial tightness. Inventory levels are declining at a pace not seen in decades. And yet, the price of silver remains wildly disconnected from its strategic importance. This is how all dislocations work. The pressure builds quietly. The market pretends nothing is wrong. And then, suddenly, everything adjusts at once. Stage 4 is the breaking point. The moment when industrial demand exceeds available supply and no inventory remains to fill the gap. What happens when the world runs out of silver for solar production? The consequences cascade. Solar installation rates decline. Renewable energy targets become unreachable. Energy becomes more expensive. Nations begin to compete for remaining silver. Export controls, national reserves, and government intervention become likely. Solar becomes harder to finance. Utilities face higher costs, and the energy transition slows at precisely the moment when global demand for electricity is rising due to data centers, artificial intelligence, electric vehicles, and electrified heating. Energy security becomes fragile. Economic growth suffers. The political implications multiply. It is not difficult to imagine this scenario. The numbers already describe it. A deficit of more than 100 million ounces per year. Rising demand from every industrial sector. Flat supply. Inventories falling. A metal that cannot be substituted in the one technology the world depends on most. This is not a minor commodity story. It is a structural vulnerability inside the global energy system. Silver is becoming the oil of the solar age. Stage 4 also forces something else, a repricing. Every undervalued material eventually reaches a moment when the market can no longer ignore reality. When the Roman denarius lost its silver content, citizens no longer trusted the currency. When Spain flooded Europe with silver, prices across the continent inflated. When the United Kingdom lost its monetary reserve, the sterling system collapsed. When the Hunt brothers cornered the silver market, the price spiked violently until regulators intervened. When Nixon ended the gold link, the entire global monetary system shifted in a single weekend. All of these events share one trait: a fundamental mismatch between perceived value and real-world necessity. When the mismatch becomes too large, the adjustment is always sudden. This is stage 5, the repricing event. The moment when industrial users must outbid all other sectors to secure the metal they need. The moment when investors and institutions wake up to the role of silver in the energy economy. The moment when governments begin to treat silver not as a precious metal but as a strategic resource. The moment when scarcity turns from an abstract idea into a physical constraint. The world is not at stage 5 yet, but we are deep inside stage 3, and the window between these stages is narrowing. Every month of deficit shrinks inventories further. Every gigawatt of new solar installations consumes more silver. Every policy initiative accelerates demand. And every year that mine supply remains flat pushes the system closer to the edge. No one should panic. but no one should ignore the pattern. This is the same structure that has appeared again and again over centuries: underestimation, accumulating pressure, sudden adjustment. And each time, the people who saw it early made decisions that protected them or positioned them for advantage. Those who ignored it faced the consequences of being unprepared. The world is entering an age when energy, materials, and technology are converging. Silver sits at the center of that convergence. When the world asks what happens if silver runs short, the answer is not simply that prices rise. The answer is that the global energy transition slows, costs increase, geopolitical competition intensifies, and entire industrial sectors must rethink their strategies. You do not need to believe this narrative. You only need to verify the numbers. Look at the deficits. Look at the supply. Look at the consumption curves. Look at the inventories. Look at the commitments nations have made. The pattern is visible. The tension is real. The stakes are enormous. Act before the window closes. Understand the structure before the breakpoint arrives. In every historical cycle, the individuals who recognized the shift early did more than survive. They adapted. They positioned themselves. They thrived.